Hi there, this is CMA Nishanth Reghunath here, welcoming you to a new video under my study for income tax. This video is the second part of our study for agricultural income and its treatment. So from the first part, I'm pretty sure you all have a really good understanding as to what agricultural income is and what are the specialties of agricultural income and its treatment in our country, what is a rural land, what are different agricultural operations, what is a farmhouse, etc. etc. Yeah. So you got all the basics and fundamentals with regards to agricultural income from the first part of our study. So besides what we learned in part 1, I had mentioned in part 1 itself that the whole study will be divided into 3 topics. Topic 1 was covered in part 1. Now topic 2 and 3 will be dealt with in this video. So the second topic, that is a case where an assessee has an income which is partially agricultural and partially from business, is what we are going to see first. See, this is a case where the assessee has a business, and this particular business has a mix of agricultural and non-agricultural portion. Say the assessee is into the business of making potato chips or making sugar. Alright, assessee is in the business of sugar manufacturing. Alright, now this sugar manufacturing has a process of growing sugar canes, converting them into jaggery and converting the jaggery into sugar. So the assessee has an agricultural activity wherein the assessee grows sugar cane. Alright. Now the sugar cane is further processed to become the final product, which is sugar, and this sugar is packed and sold by the assessee. So if you check this whole activity has an agricultural portion, that is the farming of sugarcane. Yeah, this is purely agricultural in nature. But whereas making sugar, that is converting the sugarcane into sugar and then packing them and selling, is purely a non-agricultural activity. Am I right? Because from what we learned from the first video, we understood what an agricultural activity is and what all can be classified as agricultural operations. Now, manufacturing sugar and packing them and selling is in no way an agricultural operation, right? So this is a non-agricultural activity, and whatever that you receive from this is a non-agricultural income, right? So this assessee who manufactures and sells sugar has a business which is in part agriculture related, agro, and in part non-agro. Agreed? Fine? Yeah? So how to compute their income? Wouldn't it be unfair to tell them that you sell a non-agricultural product, so you will not get any relaxations with respect to your agricultural activity? Wouldn't that be unfair? So what Income Tax Act has done here is, Income Tax Act brought in certain provisions, certain rules, where Income Tax Act says, if you are into such business, we will provide you with two kinds of treatments based on what business you are in. One is a special treatment, and that's available for assessees who are into the manufacturing of rubber, coffee, and tea. Now this treatment is purely based on percentage. This is a percentage based treatment. And then for other assessees, for example, the assessee who manufactures sugar, or if an assessee who manufactures potato chips, who himself cultivates and farms potatoes and all, we have a general treatment. So for assessees who are into rubber, coffee, and tea manufacturing, you have a special treatment based on percentages. Whereas for other assessees, you get a general treatment. So first, let's check the special treatment out. As per special treatment, we have certain rules. Also, please do keep in mind this item of study will be very important in your study for PGBP as well, wherein we'll be learning a special item from section 33AB, a section named 33AB, wherein we'll be seeing this exact same thing again. Alright, so just keep that in mind, or just make a note that this will be important when you learn PGBP as well. So anyway, coming back. So as per special treatment, what the Income Tax Act has said is, or what the Income Tax Act has done is, they brought in certain rules for rubber, coffee, and tea manufacturing assessees. And based on those rules, they said, now take your total income, and out of that total income, 1% you set aside as agricultural income and don't pay tax for it. Another percentage, the balance percentage, treat it as business income and pay tax for it. Alright. So the rules are 7A for rubber, 7B for coffee and 8 for tea. So 7A, manufacturing rubber. The Income Tax Act tells that if you are in the business of manufacturing rubber, take your total income and 65% of it, treat 65% of it as agricultural income and don't pay tax. Balance 35%, treat them as business income and pay tax for it. Simple. 65 agricultural income, no tax. 35 non-agricultural income, pay tax. Simple, right? Next, coffee. Now with regards to coffee, the Income Tax Act bifurcated the rule 7B. They brought in 7B1 and 7B1A. Under 7B1, the Income Tax Act classified a particular category of coffee manufacturers and sellers. They are the ones who grow coffee and cure them and sell the coffee product as grown and cured. Alright, just grown and cured. So they essentially sell coffee beans which are grown and cured, not coffee powder, not coffee granules, not dust. Alright, they sell coffee beans as grown and cured. Now in such a scenario, treat 75% of your total income as agricultural income and 25% as business income. Say your total income is 200 lakhs. You sell coffee grown and cured. Out of this, 75%, that is 150 lakhs will be agricultural income. And the balance of 50 lakhs will be non-agricultural income. Alright, now for agricultural income, no tax, it is exempt. Alright, for non-agricultural income, pay tax. Fine, that's how it works. Now in case you are a coffee manufacturer and seller, but then you grow your coffee, cure your coffee, roast your coffee, ground them into dust and you mix chicory or not and then sell. That is, you sell coffee powder. So what happened here? The share of your further processing increased, right? So you are not just growing and curing, you are doing more than curing. You are curing, roasting and grounding. That means your business activity share increased. Fair enough? Yeah? So in that case, the Income Tax Act tells us that increase your business share from 25 to 40 because obviously your business activity increased, and reduce your agriculture share from 75 to 60. That's it. Reduce your agriculture share. So in the same example, what had happened? Your agriculture would be 260%, that would be 120 lakhs, and instead of 50 lakhs, your business activity income would be 80 lakhs. That is a split of 60% and 40% because your business activity increased from just curing and it went to curing, roasting, grounding. Alright, simple. Now if you are into the manufacturing of tea, rule 8 tells us that split your total income into agricultural portion at 60% and business at 40%. The same as that of coffee grown, cured, roasted and grounded. Simple, right? So that's all you need to know. So if you get a question and in that question you get an assessee's case and he's into coffee manufacturing, and if the question asks you to find out the assessee's total income for which he'll have to pay tax, check whether it's coffee grown and cured or grown, cured, roasted and grounded. As per the category, split the total income as per the percentages that you see in this table. Simple scenario, right? Yeah. Now this is specific treatment. Now regarding the general treatment, that is the case of sugar manufacturers who cultivate their own sugarcane, or potato chip sellers who cultivate their own potatoes. We have a general treatment for which I'll first give you a diagram to understand the whole scenario. Say you have a farm. Alright, you have a farm. This is your farm. Alright. In this farm, you cultivate potatoes. Alright. Now, these potatoes you use in your business. You take them to a factory. And from this factory, you convert these potatoes into potato chips. And you finally sell these potato chips. Alright. But then there can be a scenario wherein you also sell some of your cultivated potatoes as well. You sell your potatoes as well. Fine. Now this is a mix of agriculture and non-agricultural activity, right? Now how to find out your total agricultural income? How to find out your total business income? That's a question here. We do not have any specific percentage rule for potato or sugar sellers and all. Now, what you should do in such a case is take the total agricultural produce. So in this case, find out the total potatoes that has been cultivated. Split them up into whatever that you directly sell and whatever that you use for captive consumption. I'm assuming you know what's the meaning of captive consumption. Captive consumption means nothing other than, it's the same as self-consumption. Alright, self-consumption. That is whatever that you take into factory. Alright, now with whatever that you have sold, that is a potato that you cultivated, you sold, that is purely agricultural income. No questions there, right? Growing and cultivating potatoes, selling them, purely agricultural operations, and whatever that you get out of it is an agricultural income. How to find out its value? Again, simple. Find the sales value, from that deduct your cost of cultivation. COC stands for cost of cultivation. Whatever you get as balance is your agricultural income. Alright, fine, simple. Now, out of the potatoes that you cultivated, certain amount of potatoes you took into your factory to make potato chips. That is, you captively consumed certain amount of potatoes. Now these potatoes you are selling. So obviously it will have a business income. It will have a business income portion. That is for the finished goods alone. But then you consumed certain agricultural product for yourself, right? With respect to whatever that you consumed, which was purely an agricultural product, shouldn't there be a deemed agricultural income? Yes, there will be. Now to find out that portion of deemed agricultural income of whatever that you captively consumed, there's a simple formula as well. Take the fair market value of the potatoes that you consume for self. Alright, it will be clearly given in the question. In case it's not given in the question, you will be able to find that fair market value based on the sales value. Alright, simple cross multiplication. So yes, find out the fair market value. For 99% of the questions, it will be mentioned in the question. Now, out of that fair market value, deduct the cost of cultivation for that portion of potatoes. And that will leave you with your agricultural income with respect to the potatoes that you consume for self. Now, add this. Let this be agricultural income 1. Let this be agricultural income 2. AI1 plus AI2 will give you your total agricultural income. Alright, so AI1 plus AI2 will give you your total agricultural income. Found out the total agricultural income. Now, with regards to the business income, that is in relation with the sale of potato chips, what should we do to find out the business income? Simple. The sales value of the total potato chips, that should be your income, right? Sales value, take it. From that, reduce raw material cost of potatoes. Now, this raw material cost will be the same as this FMV. So this is the same as FMV. That's the value that you take over here. From that, if there is any further processing cost, that is processing cost that you incur to convert the potatoes into potato chips, all that cost for your factory, reduce that as well. And then you will get your business income. Simple, right? Simple concept, right? Now that's it. In case you have a doubt, I can give you a question. I will take a question and break it down and show you how to do this whole process. Super simple though. So yes, you do try out questions in your study materials. In case you have any doubt, please reach out. I'll post a video with solving a question for the same concept. Alright. So with that, done with the second topic of our study. That is a case where an assessee has a total income which is a mix of both agriculture and non-agriculture. So both special treatment and general treatment done. Now let's go to the case of partial integration. Now this is a very interesting area. This is a very, very interesting area. Now, this is a case of special treatment for certain categories of assessees during certain special scenarios. So what we usually do here is we add agricultural income to non-agricultural income and carry out a special tax liability computation. Special tax liability computation. See, from what we learned under section 10.1, agricultural income is completely exempt, right? We do not have to bring them to total income while computing tax liability. But as per partial integration, yes, they are exempt. Yes, they are exempt. But there is a special treatment. There is a special treatment wherein you actually include them for a certain calculation. Alright. Yeah. So let's check what the special treatment is and what is this special category or special scenario which calls in for this treatment. For that we have certain conditions. Let's check those conditions. Condition number 1. Assessee should be an individual HUF, BOI, AOP or AJP. That is, assessees shouldn't be firms or companies. That is, for firms and companies, no partial integrations. That is, the complete agricultural income will be exempt for firms and companies. But for individual HUF, BOI, AOP and AJP, that is artificial judicial person, check whether partial integration is applicable. If applicable, include agricultural income in total income computation. Now another condition. The agricultural income of the assessee exceeds rupees 5,000. That is, agricultural income exceeds 5k, more than 5,000. Third condition, non-agricultural income exceeds basic exemption limit. You know what all are the basic exemption limits, right? For a normal resident individual, it's 2,50,000. Yeah, up to 2,50,000 you are exempted from paying tax. For a senior citizen, it's 3 lakh. For a very senior citizen, it's 5 lakhs. So this particular assessee's non-agricultural income should exceed the basic exemption limit. Now, there is one very key important thing that you need to know here. When we check our non-agricultural income, whether it exceeds the basic exemption limit, we take the total non-agricultural income. But while calculating partial integration, we only use slab rate incomes. That is, to check whether the income exceeds basic exemption limit, take all the incomes of the assessee. But while calculating partial integration, ignore incomes which have flat rate. For example, LTCG, STCG under 111A, casual incomes, things like this. Ignore them while doing partial integration. Ignore them. But include them while checking your income exceeding basic exemption limit or not. So ignore them while doing partial integration, but include while checking total income exceeding basic exemption limit. Fine. Now let's see how we can calculate this particular item called partial integration. For that we have 4 steps. Now I'm not going to take you through these steps direct. I'll give you an example first. And with that example I'll take you through these steps. Alright. So our example is a case of one Mr. X, age 42. His non-agro income is rupees 3,25,000. His agro income is rupees 2,55,000. We are asked to compute total tax liability. So let's check all the conditions one by one for partial integration. Number one, assessee should be an individual. Fine, assessee is an individual. Agreed. Assessee's agro income exceeds 5,000. That's the second condition. Okay, second condition agreed. Your income, agricultural income exceeding 5,000. Number 3, non-agro income should exceed basic exemption limit. Mr. X being age 42 and a resident individual has a basic exemption limit of 2,50,000. So obviously that is exceeding as well. Alright. How to compute total tax liability? Now, this is a case where partial integration is applicable without doubt. Yeah. Now let's see how partial integration works. So draw a table with particulars particulars and amount. Pardon my handwriting. First, calculate the total tax liability by including agricultural income and non-agricultural income in your total income. That is tax liability. I am using short forms for everything. Tax liability for total income of 3,25,000 plus 2,55,000. That is a total of 5,80,000. Total income of 5,80,000. Calculate tax liability, and this tax liability should not include cess. Okay, no cess here, no cess. So for 5,80,000, your total tax liability will be 12,500 plus 80,000's 20%, which will give you 16,000. 16,000 plus 12,500 is 28,500. Alright, using basic slab. Next, find tax liability for total income. Sorry, not total income, for a special income. Special income. That is total of agro income, that is 2,55,000 plus the assessee's basic exemption limit. What is the assessee's basic exemption limit? 2,50,000 is the assessee's basic exemption limit, right? So for 2,55,000 plus 2,50,000, that is a total of 5,05,000. Compute tax liability without cess for 5,05,000. How much would that be? 12,500 plus 5,000's 20% would give you 1,000. That is 13,500. Alright, you found two tax liabilities. Now what you should do is deduct what you found in the second step from the first step. Deduct 13,500 from 28,500. What will leave you? Will you be left after that deduction? You will have a balance of 15,000. This is your tax liability. Simple, right? All that we did there was we found out tax liability without cess for the total income, including agricultural income and non-agricultural income. That is step 1. Calculate tax liability for total income, including agricultural income, but without cess. Step number 2, we found out tax liability for a special income. That is, we calculated tax liability for basic exemption limit and agricultural income. Right? We added 2,50,000 with our agricultural limit, 2,55,000. We found out tax liability. In the third step, we deducted step 2 from step 1, amount from step 2 from amount from step 1. Right? And that's how we got our tax liability. Simple. Now all that you have to do is add cess. But then, in this scenario, what is the assessee's total taxable total income which is taxable? What is assessee's normal total income which is taxable? It's just 3,25,000. Yeah, 3,25,000. And as per section 87A, isn't there a rebate available for him? Yeah, 12,500 or 100% of your tax liability, whichever is lower. So here, isn't the assessee eligible for a 12,500 rebate? Now the net tax liability, the balance tax liability of the assessee will be nothing but 2,500 rupees. Yeah? That is, we just charged, or we just gave the rebate of 87A. And while giving 87A rebate, always remember, you check only taxable total income. Do not include agro income of 2,55,000 with 3,25,000 to see whether his total income is crossing 5 lakh or not. Because total income shouldn't cross 5 lakh as per section 87A to get rebate, right? Simple. Now after rebate, all that you have to do is add cess at 4%. So 2,500's 4% is 100, and your total tax liability will be 2,600 rupees. Now that is what partial integration is. Simple scene, right? So steps are here, and we just worked out all those steps with this particular example. So I'm assuming you got a really good understanding of the two topics that we learned here. That is the topic of an assessee who has a total income which is a mix of both agricultural and non-agricultural incomes, and then the special topic of partial integration. In case you have any doubt, please feel free to reach out. I am always here to provide you with any sort of assistance to make you understand tax better. So with that said, signing off, this is Nishanth Reghunath. See you in my next video. Take care and goodbye.